Nigeria imported capital cumulatively worth $4.51 billion between January and September 2021, representing a 47.6% decline compared to $8.6 billion recorded in the same period of 2020. According to the capital importation report for the third quarter of 2021, recently released by the National Bureau of Statistics, the total value of capital importation into Nigeria in the third quarter of 2021 stood at about $1.73 billion, beg your pardon, $million from 875.62 in the preceding quarter of 2021. And this shows an increase of over 97%. Well, we have Babajide Atolagbe, a treasury analyst at AfriInvest Asset Management Limited, joining us on the show now to tell us what he understands and what the implication of these figures are to the Nigerian economy. Good to speak with you, Babajide. Good morning. So foreign portfolio investment contributed the largest amount to capital inflows, accounting for $4.31 billion, and that's over 70% of the total capital importation. Is this mostly equities, or is it more than equities?
No, not really equities. So the breakdown of the numbers actually show that equities accounted for less than 5% of the total value. And this has been the trend for the last couple of years because Nigeria has a lot of structural challenges, which was further heightened by the pandemic. And speaking of high inflation, FX scarcity, policy inconsistency, and insecurity issues, among many others. And typically what we know is that investors like to shy away from asset classes that exposes them to domestic and structural risk. Also, the equities market does not really have the liquidity requirement to encourage FPIs to participate in that space. And, even the local investors, such as PFAs and asset managers, they don't really throw their weight in the equities market simply because of the inherent risk. So you don't really expect to see a lot of traction going into that space from foreign investors. And going forward, we expect this to persist simply because, the pull side factors are still, are still in the corner. We need to create an enabling environment for businesses to thrive. And if we are able to iron that part, probably going forward, we might begin to see some sort of traction in the equity space. But on the other side, we saw that 65% of the flows went into the money market space, and that simply tells us that investors prefer to play in a space that is that guarantees their capital and offers some sort of decent yield.
Okay, so should we be worried? I know we've had this conversation with some other people, like you mentioned, just about 5% of equities account for this huge number from the foreign portfolio. And so we have more of local players there. And of course, it does have its advantages. But should we be worried, or should we just relax and try to get more local players into the equities and let the foreign portfolio go to the other investments?
I think we should have a mix of both local investor and foreign investors, simply because it gives us some sort of liquidity, and it simply tells us that Nigerian companies are actually worth investing in. So over the years, local players are not even throwing their weight in that space, because if you look at the PFA allocation equities, you will see that it is barely above 6%. And compared to what they are investing in other fixed income instruments. So I think for us to have a dynamic market that contains both local and foreign investors, we need to set our structural problems right. We need to make sure that our economy is worth investing in, and all these structural challenges are put in the corner so that funds can begin to flow both locally and internationally.
Okay, so you earlier mentioned making the environment conducive, and now you talked about structural challenges. Being specific now, what are some of those things you think should be amended or put in place to boost investments in this area?
Practically for equities, from our observation, one of the major areas that we can tackle to attract flows is policy, inconsistency. Investors want to be sure that when they are bringing in their money into Nigeria, their capital is being preserved, and also when they want to exit the market, they are able to see enough liquidity to get their money out as at when due. So if we can be a little bit, consistent with our policies and, also tackle the issue of inflation, all those structural issues ranging from transportation, insecurities, and a couple of others, if we're able to put all of that into place, we could see, foreign flows actually come into Nigeria equity space. And, of course, it will also encourage local players, asset managers, pension guys, and even the insurance guys to throw their weight in the equity space.
All right. So in the report there, other investment, with just 22.7%. Could you explain to us what these other investments are and how we can, is it possible to increase this 22% at least to something appreciable?
So other investment that are not financial, not capital wise in terms of not equity, not bond, and not not money market. But on the flip side, we having just 22.7% allocated to just other investments is not actually safe, because if you look at the numbers, about 65% goes to money market. And the downside risk to that is that this exposes the economy and the capital market at large to external shocks and volatility. I think where Nigeria should be more, focused on is FDI, which is foreign direct investment. Foreign direct investment is not, unlike FPI, unlike FDI. FPI is easy to liquidate and usually short-term flow. FDI would actually impact the broader economy, because this is basically investors bringing in their money into Nigeria and investing in capital projects such as transportation, healthcare, and a couple of others. And if you notice, this type of investment are what we need, because they will actually create more jobs for Nigerians, in our economic output, and also bring about economic stability. And if you've observed that this FDI has been the major driving chances for other African economies like Ghana and South Africa. So if Nigeria can actually, set their local priorities right, and create an enabling business environment, we're likely going to attract FDI, and that will also drive our economic stability going forward.
And still looking at the report, we see that Lagos once again ranked the top destination of capital investment, as importation was up by 97% first for the third quarter of 2021. Well, we do know that Lagos is the commercial capital of Nigeria, but what lessons can other states learn from Lagos, to also up their game in this area?
Frankly speaking, I don't think Lagos is doing anything or has done anything extraordinary to attract capital investment, aside from the fact that it is the commercial capital of Lagos, of Nigeria, I beg your pardon, and is headquartered to major institutions. Naturally, it is just bound to have more flows. But if you take out all of these natural advantages away from Lagos, you will find out that Lagos is just like almost every other state. So what I'm just trying to say is that many states are alike. Nigerians and states are not doing so much to actually attract investment. But the message here is that stakeholders, both at the federal and at the state level, even at the grassroots level, they need to actually wake up and start taking conscious measures to bridge the country's infrastructure gap, invest heavily in human capacity development, and also keep insecurity issue at bay. I mean, these are the major tickets to actually attracting capital flows into any developing economy. And if you've observed in the last 3 to 5 years, you've seen a lot of funds flying across the globe to invest in startups, startups in tech, in healthcare, in transportation, and a couple of others. So if Nigeria is actually ready, we can actually prove to the world that we are a reliable destination to these funds if we can actually reduce our country risk premium in the short to mid-term.
Yeah, when you mention all those tech startups and all that, I mean, like we always say, Nigeria has the potential, but I guess the thing is getting our hands into the soil and getting the job done so that we will see the results. But would you say Nigeria is optimizing the opportunities? I mean, Africa is like the largest market now, greenfield, untapped resources everywhere. Would you say that we are intentionally working towards maximizing some of these opportunities?
I wouldn't say we are optimizing it in the best possible way, because Nigeria has the human capital. We have our population is filled with young guys who are actually ready to actually learn. We've seen Nigerian young guys thriving in different sectors when they leave this country. So now, I wouldn't say we are really, really leveraging on our resources to actually, attract this capital and also put ourselves on a good pedestal. I think we are overly concerned about political issues and some sort of nationalization issues. You take, for example, look at the OPE event that happened just in 2020. OPE was a business that was already thriving, and it was really, really helping Nigerian commuters in the transportation sector. But simply because of the ban and the ban that came from Lagos State government, you could see how that investment was basically dumped. All the resources that were put into that investment were completely nowhere to be found. So I think the government also needs to take up the task and also make sure that they encourage foreign investors that when you come and invest in Nigeria's human capital space, which is basically leveraging our youth population, we are going to provide you with some sort of comfort and shield you from all sort of political instability. So if the government can actually assure investors that, okay, if you bring in your funds, we'll make sure that you're not exposed to a number of risks. This will actually go a long way in attracting, investors from different areas of the world.
All right. And how do you see the 7% inflation rate in the United States affecting Nigeria's financial markets?
Typically, we don't expect to see a direct impact on the other market generally because the US market and the Nigerian local capital market are not priced in a similar manner. I mean, however, we expect that the Nigerian's Eurobond market, which is dollar denominated, is going to take a material tanking on the back of rising inflation because the Fed has actually signaled that benchmark rates are going to be hiked in the US. And obviously, the implication is that we expect global yields to rise and therefore driving prices lower. And if you've been following the Eurobond market lately, you see that that has actually played out in that space. Yields have risen, materially, and prices are dropping significantly. But indirectly for the local market, I feel that if rates are jacked up in the developed markets, the CBN may be tempted to actually raise benchmark rate locally to actually retain and attract foreign capital. And that might, to some extent, indirectly push yields in the fixed income space higher and definitely pressure local equity valuations.
So from your eyes now, MPC is coming up soon, I think on the 24th or so. What do you see? What decision do you see?
It's still a little bit unclear because we know that the CBN decision is based on a number of factors, and one of it being macroeconomic indicators, looking at GDP numbers, unemployment, and a couple of other macroeconomic indicators. Firstly, we need to understand the fact that the reason why interest rates was actually jacked lower in 2020 was because the economy was dwindling from the impact of the pandemic. And the CBN had to actually put some sort of caution to support the economy. So the big question is, is the Nigerian economy now stable enough? And is it back to pre-pandemic levels to the extent that CBN will be able to actually take away the support in terms of by hiking interest rates? And secondly, we've observed that over the years, Nigeria seems to follow the decision that other emerging markets like Turkey, Brazil, Russia, and a couple of others follow in terms of monetary policy rate. So if at the global space we see rates rise significantly in 2022, the CBN will be forced, or let me say, will be encouraged to actually raise rates in order to retain capital and also make sure that this little foreign capital importation we are rejoicing about is not completely wiped off.
And so share with us your outlook for 2022 when we look at the markets.
So for the market generally, it's going to be, it's most likely going to be a tough year simply because of policy normalization across the developed market. But in terms of strategy, I would advise investors out there to make sure that they are highly diversified across and within different asset classes. That way, if you are being exposed to higher interest rates in the bond market, you still have some sort of cushion either from investing in alternatives or investing in equity space. Also, cash has always been king and will forever be king. So it's always advisable that you have a significant portion of your portfolio in cash so that you're able to take advantage of any opportunities that come up within the year. And lastly, we expect that for those who will be playing significantly in the fixed income space, most of the activities should be centered around the short end of the curve, simply because whenever there's policy normalization, we usually see rates, yield drive higher on the long end of the curve. And basically, we should also look at investing in corporates, because corporates are much more stable and they don't tend to be as volatile as sovereign instrument when compared to sovereign instrument. I beg your pardon.
All right. Thank you so much, Babajide Atolagbe, Treasury Analyst at AfriInvest Asset Management Limited. Thank you so much for sharing your thoughts with us and your perspective. Enjoy the rest of the day, and in fact, have a great weekend.